Hello, ladies and gentlemen. I hope you are fine wherever you are. I am the Acca tutor, Mr. Jerem Tumkulu. In this video, I'm going to discuss certain issues which you have encountered in your this week's notes. Okay, in this week's notes, and I just want to target especially the workings part as well as to explain certain theories which are linked to this week's task. All right, so we touched a lot of things. We looked at the sources of business finance, the dividend policy, and the foundational aspects related to capital structure. All right. So basically, with regards to the sources of business finance, we looked at various uh, sources like uh, ordinary share capital, ordinary share capital. Okay. We also looked at debt as a source of finance and also preference share capital. Okay. And the ordinary share capital, we said um, normally this is um, equity, okay, equity finance, okay. But when we are talking of equity finance, we are referring to certain things. For example, we are referring to the nominal part, the nominal value of this share capital. We are also referring to the share premium. Then we are also referring to retained earnings. Okay, and retained earnings are those funds which have been generated from uh, the ordinary operating activities of a business. Okay, its major operations. All right, so those profits which we do not use or which we do not distribute to the shareholders, that's what we call the retained earnings. All right, so they are a form of finance for a business because a business can use those, can decide to use those ones if it considers it fits not to engage in debt or engage in issuing shares, because sometimes when you issue the shares to the public, you end up diluting the shareholdings, the current shareholding, and in the process reducing the earnings per share. Okay, because when the small earnings are now being distributed or are now being claimed by a wider number or a large number of shareholders, then eventually the earnings per share will decrease. Okay, so those are the considerations which might come into play, or the managers might consider it not expedient to incur further debt because they feel that uh, the profitability of the enterprise would be compromised by increased interest obligations. So, by the end of the day, they may decide to just use internally generated funds in the form of retained earnings. Now, when you are talking of issuing shares, okay, because the shares need to be issued for them to give us money, all right. So, if we are already a listed entity, then we can decide to issue shares in the form of okay, if listed, we can issue shares through what is called public issue. Okay, public issue. All right, when you're talking of the public issue, this is just an offer for subscription. We are offering the shares to the public for them to subscribe to those uh, shares. So that's a sale uh, um of shares directly to the members of the public or to the general public. Okay, so what happens is the shares are advertised at a fixed offer price and the public are invited to buy them. All right, so in that process, the company will be raising capital, will be raising finance for its business. All right, we can also do what is called a public offer. Okay, public offer for sale by tender. Public offer for sale by tender. All right, in this case, a sale, okay, is just being made. All right, this is just a sale being made direct to the general public. However, a price for the shares is not fixed. All right, a price for shares is not fixed, and the public are invited to bid for those shares. All right, if we are seeing that our business is actually a promising entity and we have done much in terms of publicity, or in terms of marketing, or in terms of advertisement, we are now a known brand, so we can actually go pedantic and cause the people to bid on their own, okay, because we just want to capitalize on the highest possible price at which we can offer our shares. So the members of the public in this case are not going to be given a fixed price, but they have to charge the most competent price, which would attract our interest, okay, at which we can offer them. So we want to capitalize on the highest possible price which we can get from issuing our shares. So that's the difference between a public issue and a public offer for sale by tender. In a public issue, we are offering the shares at a fixed price, but in a public offer, we need to have the members of the public bid for those shares, and it is at that price which is the highest, which might actually lead us to offer those or to sell those shares. Then there is what is called placing. Okay, placing. Now, with placing, a sponsor, usually a merchant bank, okay, arranges for its clients to buy shares. All right. However, at least 25% of the shares placed must be made available to the general public. So when we are using the placing technique, we'll be using a merchant bank to actually sell our shares. But in this case, it is the merchant bank who will be doing most of the administration of, for the sale, in terms of gathering or sourcing those buyers for our shares. All right. However, there is a stipulation that at least a certain percentage, depending on jurisdiction, but generally it's a 25% clause that says that at least 25% should actually be offered to the members of the public. Then we also have an option to offer what is called a rights issue, and this video is actually biased towards putting more energy on the rights issue. Okay, this is an offer to our existing shareholders, okay, for them to buy new shares in proportion to their existing shareholding. Okay, so to those who are doing the Acca financial management paper, they are likely to be questioned or to be required to calculate or to compute the theoretical ex-rights price or the value of the rights issue and so forth. So you need to actually be conversant with the relevant workings. So in that regard, I think it is actually expedient for us to explore more on the rights issue. Now, a rights issue is an issue of shares to existing shareholders. Okay, the number of shares that each shareholder is offered is in proportion to their current shareholding. The shares are offered at a relatively low price, and the effect of the issue is to reduce the market value of all the shares in issue. Okay, usually they are being made. These rights issue are usually an arrangement that is made when we see that our share price has become overvalued sometimes, okay, or is becoming beyond the reach of many. Okay, many investors are seeing it not worthwhile to invest in our shares because the share price has actually gone uh, up. So, but we need the money. So by the end of the day, we need to offer these ones to our existing shareholders. All right, so that by the end, after the offer, usually the share price will go down, and we are having an advantage of making our current shareholder happy, but at the same time we are also attracting new investors, or the general public, to invest in our shares, and in that process we'll be earning money as well. So shareholders not wishing to take up their rights can sell them on the stock exchange. It is cheaper than a public share issue. Why? Because the administrative elements or administrative task that is required is minimal, as we are only selling these shares to our current shareholders. So much of the administrative work is minimized, so it is actually cheaper. It is made at the discretion of the directors without consent of the shareholders or the stock exchange. So there is very minimal protocol to be observed. So it is actually a decision that can be made by the board of directors. And usually this arrangement does not fail. Now, what comes in most examinations is the computation of the theoretical X-right price. Okay, the new share price after the issue is known as the theoretical X-right price. This is the price of a share immediately after the rights issue, and it is calculated by finding the weighted average of the old price and the rights price weighted by the number of shares. So the formula is the market value of shares already in issue plus proceeds from new issue, all divided by the shares in issue after the rights issue. That is the X rights. Okay, the X rights. Now, let us go through this example and see if we can make sense out of everything. Now, the current share price is $5 per share. The company makes a rights issue of 1 for 4 at $3. You can see that from this information, the current share price is $5, but just to encourage our existing shareholders to take up the rights, we are offering the shares at $3. However, we are only offering one share for 4 already held. Okay, so we are now required to calculate the theoretical X rights value per share and to determine the value of the right. So to do this, we just have to be very systematic. Okay, let us consider a holding of 4 shares. All right, so we are having shares. All right, then we are having the amount this side. So the current shares held, we are talking of 4 shares. All right, and these have got a value. Okay, the value of 4 shares is 4 multiplied by $5, and this gives us 20. Then we offered a rights issue. Okay, that is 1 for every 4. So a new share that has been issued, that's 1. All right, and we are offering this share at $3. So the total shares we now have are $5, and they are now costing $23. So what is the value of one share? I mean, what is the theoretical X rights value per share? So in this case, the theoretical X rights price is equal to $23 over how many shares? 5 shares, and we are going to get $4.60 per share. Now, what about part B? Part B is requiring us to compute the value of a right. What is the value of a right? All right, so here we have to consider, okay, part B, we have to consider the new value, the new market value, okay. The new market value in this case is the value which we have just calculated as $4.60. Remember, we have determined it as $4.60. Now, we then have to say how much was the investment, the rights issue. We bought the shares at $3, or they were offered at $3. So the value of the right is the difference. Value of the right is actually $60. So this is actually what we have gained from participating in the rights, or from in taking part or in buying the shares which were being offered in the rights issue. All right, because we bought them at $3, but their market value is now $4.60, so we have gained $1.60 there. Okay, but for it to make sense, let us try this other example and see if we can make some sense out of it. The current share price is $8 per share. The company makes a rights issue of 1 for 3 at $6 per share. A, what is the X rights market value? Okay. B, what is the value of a right? And C, Miss Xavier owns 1,200 shares. She takes up half her rights and sells the other half. Calculate the effect of on her wealth. Now, this is actually a very important question because it brings into perspective the essence of a right issue. Okay, the essence. Because remember, by the end of the day, the shareholders themselves need to benefit, or need to determine the cost benefit analysis. They should make that analysis to see if it is worthwhile. So for part A, we just do the regular computation. Okay, we need the shares, we need the amount. Now the current shareholding is 3 shares. Okay, that's 3 shares, and they are being the current share price is actually $8. Okay, sorry there. So that's 3 by 8. This gives us 24. Okay, and then new share from the rights issue. The new share is 1, all right, and this one is being offered at $6. So obviously we are now having 4 shares at $30. Therefore, the TERP is equal to 30 over 4, which gives us $7.50 per share. That's $7.50 per share, okay? And this is actually the new market value of the share, all right? So new market value of the share is the same as the theoretical ex-rights price. Now let's determine part B. This was part A, okay? Part B, we are required to determine the value of the right, okay? The value of a right. So we say the market value, that's part B, market value, which is the theoretical ex-rights price of this particular share, is $7.50, and the cost of the right was $6. So the benefit there is $1.50, which is the value. Okay, now part C, Miss Xavier owns $1,200 shares. 1,200 shares. She takes up half her rights and sells the other half. Calculate the effect of these transactions on Miss Xavier's wealth. All right. So in this case, we need to determine Miss Xavier's current position. Okay. Let's talk of Miss Xavier's current wealth. Miss Xavier's current wealth. She has got 1,200 shares, okay, which are trading at $80. This is the current market price. So that's 9,600. Then a rights issue comes. The directors have offered her a rights issue. Okay, so the new wealth. In this case, the shares. Sorry, my pen. Sometimes this pen, simply just misbehave. Okay, so in terms of the number of shares or the value of shares, okay, there is 1,200 already held, okay, plus the question is saying that she takes up half her rights and sells the other half. This simply means that in terms of shareholding, she only takes half of the rights, okay, half of those shares which have been issued to her. She takes half as part of her shareholding and then disposes of the other half. In other words, she actually participated in the rights issue, okay, but in terms of shareholding, she only said only half should actually increase my shareholding, and then the other half I'm selling. Okay, she is selling, because what happens in the rights issue is that the shareholders are given the right when they accept the right, they are given the shares, all right, but they may decide to say, I want all of them to just increase my shareholding, or I will say half should increase my shareholding, and then I sell the rest on the stock exchange. remember, there could be some gain. Okay, there is some gain because we have determined that the value there, the value of the gain is actually $50. Okay, it's $50. There is a $50 gain here. We determined it. There is a $50 gain which they can enjoy if they sell. All right. Now, let us see what is going on. All right. So she already has 1,200 shares, and then she was now offered a rights issue. So the new shares which she has acquired in the rights issue, all right, the new shares actually acquired that's half, okay, of a third, because remember the she was offered 1 for every 3 shares, so that's 1/3. All right, multiplied by the total number of shares she had, 1,200. Okay, and this actually gives us 1,200 shares already held, plus here a third of 1,200, that's 400, multiplied by half, that's 200. So actually you can see that these were the new shares, the rights issue. Okay, this actually is half of the rights issue. In total, they were actually 400. Okay, they were actually 400. That's a third multiplied by 1,200. That's 400. However, in this case, half were brought as part of the new shareholding, whereas the other half was sold. So the new shares that are now belonging to Miss Xavier as part of a shareholding, that's a total of 1,400 shares. And these shares are trading at $7.50. Okay, they're now trading at $7.50, which is the new price, okay, after the rights issue. All right, the new price after the rights issue. So this one is actually the theoretical X rights price. So obviously, if we do our multiplication, we must get about $10,500. 1,400 multiplied by 750, we must get 10,500. So that's the value of the shares at the moment. Now, in terms of the cash movement, there was a sale. Okay, she sold the other half. Okay, the other half. All right, we can simply do the same computation and say the other half was half multiplied by 1/3 multiplied by 1,200, and you can get 200 at how much? This is the sale of the rights. The sale, these were sold. So when we made a sale, we are only looking at the benefit. All right, we are only selling the extra, the value of the right. Okay, we are only selling the value of the right, and in this case that's $50, because we determined that the value of the right was $50. So we are selling $50, which means this gives us about $300. So that was actually the benefit we got. But we can't get the benefit alone. Okay, we can't get the benefit alone. There was a cost of the right. The cost of the right was there were 200 shares. Okay, 200 rights multiplied by the cost of the right was $6 per share, according to the question. $6 per share. So in this case, we have to deduct 1,200. Okay, so you can see that we benefited 300, but we paid 1,200. So by the end of the day, we incurred $900 in terms of costs. So we have to deduct the $900 from our 10,500 on top there, and by the end of the day we come to 9,600. So the new wealth comes back to our original position. So what happens? What happens is, whenever a rights issue has been given, shareholders need to take part, otherwise they lose. So this is why we mentioned here that usually the rights issue does not fail. Why? Because if you do not participate in the rights issue, you are going to suffer. So let us look at this particular example, the last one, and see what happens if a shareholder decided to be adamant and ignores to take part in a rights issue. Okay, so when a shareholder just decides to just be stubborn and ignore to take part, then they end up suffering severely. Their wealth will shrink. Okay, so a rights issue is not an exercise that we should underrate or ignore. We need to participate. All right. Now we have got a company called Rabel Co, which has an issued share capital of 2 million shares, having a current market value of $2.70 each. It made a rights issue of 1 new share for every 2 existing shares at a price of $2.10. A shareholder B had 1,000 shares in Rabel Co before the rights offer. Calculate the effect of the net worth of B of each of the following options. The facts were: number 1, take up the shares; number 2, sell the rights; number 3, do nothing. So the rights issue was actually based on the ratio 1 for every 2 shares already held. We have got the cum rights price. Okay, this one is before the rights. The price before the rights is given here, $2.70. Okay, the X rights price, this one is after. Okay, and then the issue rights was actually $2.10. Okay, the price at which we offered our shareholders. Remember, it should be slightly below, okay, below the market price, the current market price of $2.70, so that's $2.10. And then the value of the right was 40 cents. So these computations have been done for you. Now you are required to calculate the effects on the net wealth of B of each of the following. So these are we are required to decide on these 3 scenarios, where in the first instance B takes up the shares. or that is, he acquires all the shares as part of his shareholding. All right, so let us determine these computations. So first of all, let's determine the market value, okay, of shares in issue. The shares in issue, we are told that there were 2 million, according to the question. 2 million shares were already in issue for this company, and the current share price is $2.70 per share, which gives a total market value of $5.4 million. All right, then when the rights issue was given, the proceeds from new issue. How much money was made from the new issue? What we only know is that the shares were 2 million, all right, and there was a ratio of 1 for every 2, and these ones were offered at $2.10. According to this table, the issue price was $2.10. That was the rights issue. So this gives us 2.1 million. This is what we get. Okay, this is what we got from the rights issue. All right. Now let us determine the number of shares in issue. X rights. All right, the number of shares in issue. X rights. Number of shares in issue. X rights. This obviously is 2 million shares already plus 2 million. Remember, we did this computation. If you still remember, you can replay and you can see that the total number of shares is now 3 million. Okay, so basically the theoretical X rights price should be 5.4 million, all right, plus 2.1 million all over the total number of shares, which is 3 million, and this should give us $2.50 per share. And this is just a confirmation of the figure which we already know, okay, because we are given that the theoretical X rights price was actually $2.50. All right, and we can also verify that the value of the right is 40 cents. All right, now there is no mark for this computation because we are told, we have already been told. So you'll be actually wasting your time doing the computations which the examiner has already done for you. I just did it just for our understanding. All right, now we need to determine what will happen. So in the case of, when B takes up the rights issue, what actually will happen? What will happen? Okay, number one, when B takes up the shares, what is going to happen? Okay, we need to establish the total number of shares B has held, okay, before the rights issue. okay, and their value. B had 1,000 shares before. All right. So B's wealth before was 1,000 shares multiplied by $2.70, and this means that B was worth $2,700. That was the value of B before the rights. Okay. Now B took part in the rights, which means B's new shares. B took part, so B's shares now, that's 1,000 already held plus 1,000 multiplied by 1/2. So this means B now has 1,500 shares. At what price? At $2.50, which is the theoretical X-rights price. So, which means that's $2,500. But B paid cash, okay, less cash paid by B to have this right, less cash paid to acquire the rights. Okay, the rights acquired are just these ones, these shares, the 500 shares, 1,000 multiplied by half, that's 500 multiplied by, the shares were issued at $2.10 according to the question. This was the issue price, $2.10. So 500 multiplied by 210, that's 1,050. Okay, that's 1,050. All right, somebody is complaining, say 1,500 multiplied by 250, it's not 2,500, but rather it is 3,750. 3,750. Okay. So if we deduct, that's 2,700. So that's the total wealth in the first scenario. The total wealth of B in the first scenario. So it just comes back to his former position because he had 2,700 already. He was at this position initially. So if he just participates in the rights issue, his wealth is not going to be compromised. Okay. Before I go any further, there are some people I understand who could be confused with the way I determined this 250. And okay, if you have been used to our initial technique of calculating the theoretical X-rights price, then let me just do that technique again. Okay, the usual technique which we started with was that to just finding the weighted average through first determining the current shareholding, or current shares. Current shareholding was 2 shares. Okay, there were 2 shares. 2 shares at 270. Okay, 2 shares at 270, and this gives us 540. All right, 540. And then new share, the new share was one share at 210. All right, the new share was at 210. So that's 210. So if we add both sides, we get 750 versus 3 shares. So this means that the TERP should be 750 over 3, and I'm sure this will give us $2.50. So either way, you are going to come to the same answer. Now let us then move on to determine what will happen if B sells the rights. If B decides to sell the rights. Okay, so if B sells the rights, if B sells the rights, now if B sells the rights, we need to determine what is going to happen. So the shares, B has got 1,000 shares. Okay, 1,000 shares, and the value of those shares after the after the rights is now $2.50, because this is the current, the theoretical X rights price. So in total they are worth 2,500. Then he sold, remember, these are the original shares. Now the rights shares, or the shares from the rights issue, all right, he's selling them. So let's determine the cash proceeds. The cash proceeds, these ones were 500 shares, remember, 500 shares. Okay, the 500 shares, all right, 500 shares at how much? It's the value of the share, the value of the rights. The value of the rights was $40 given. Remember, this was given. The value of the right was 40 cents, or 0.40. All right, that was the value of the right. So if we sell, we are only going to get that. We are only going to get that. All right. But why is it that we are only going to get the value of the right? All right. Remember, the shares have been given for, to the shareholders. Okay, they've been given to the current shareholders, right? And they were given at 210. All right, they were given at 210, but the theoretical X rights, the value of the share after the issue was 250. So obviously the gain, the value, is just 40 cents. So if we sell, okay, if we sell, the amount of money we are only going to get, the amount of money we are only going to get is just the 40 cents. All right, we are only going to get the 40 cents. All right, because the 210 part of it, we're only going to sell these shares at 250. All right, so this was the cost. So obviously what we are going to get in terms of in terms of value, in terms of the cash, is actually the 40 cents. In terms of wealth creation, we're only going to get 40 cents. All right, so remember we are calculating the impact on the wealth, not on the cash flow of an individual, but on the wealth of the individual. So 40 cents is going to be made. All right, so that's the cash he's going to get, the 40 cents. So 40 cents multiplied by 500, this should actually give us a 200. All right, so if we add up the total wealth B is going to get is 2,700, the total wealth. And once again, we are back to our original position of 2,700. This was the position of B before anything else. So either you take up the shares, all the shares, and increase your shareholding, okay, you are still going to come to the same position you were before the rights were exercised. Then if you sell up the rights again, you're still going to come back to the original position as we have already discovered here. You come to 2.7. Now let us consider the last scenario where we say that sometimes if you do not exercise, usually if you do not exercise the rights, or if you do not participate your rights, I mean in the rights issue, as a shareholder, you are going to be at a disadvantage. So in this case, if B decides to do nothing, then it won't augur well with him. All right. So in this case, the shares of B, that's part C, or number 3. The shares of B are 1,000 originally at 250, which is the theoretical ex-rights price. Okay, even if you do not participate in the rights issue, if you do not participate, the theoretical ex-rights price is going to affect your shares as well. So the B's shareholding will be 2,500, and then because he has decided to do nothing, this is going to be his total wealth. So you can see that it has decreased from 2.7 to 2,500. So if you do not participate in the rights issue, then you would be worse off than others. Okay, by doing nothing, you theoretically eventually forgo the right to the new shares. So you would lose out from those new shares, from the benefit that comes with the new shares. Okay, that is it. Let us now proceed to the other issues. Okay, now let's migrate to this area called dividend policy. Okay, remember in our first lecture to this course, we discussed about the financial management objectives, and we outlined 4 of them, where we said that the finance manager has to worry about investment decisions, financing decisions, dividend decisions and risk management. So basically, these are the decisions the finance manager has to worry most about. Okay, and we've done much so far. We've covered these ones and these ones. Those are the um, some of the issues we were talking about when we were talking of the sources of finance and how, of course, we are not yet through with the financing decisions because we also have to go deeper into the area of the optimal capital structure. We need to discuss those ones, and then we have to move on to what are called dividend decisions. And the dividend policy is actually the center or the core of those decisions. Then lastly, we'll look at risk management in the last lecture. All right, so here we go, ladies and gentlemen. Let us just fasten our seat belts. Okay, now with regards to dividend policy, the main idea here is that we need to determine what form of dividend practices shall we follow as a company, and the finance manager's duty is actually to implement those policies with regards to the interest of the owners of an enterprise. So we are guided by different theories which are usually followed in financial management wherever dividends are concerned. There is what is called the dividend irrelevance theory. Okay, this has been put across by Modiglian and Miller, okay, who argued that in a perfect market where there are no taxation, transaction costs, and market imperfections, existing shareholders will only be concerned about increasing their wealth, okay, either through a dividend or from capital growth. All right. These economists or authors, they believe that wealth maximization of a shareholder is going to be fulfilled if they receive either a dividend or the capital growth. So it doesn't matter whether they receive the dividend per se or they just enjoy capital appreciation on their investment. So the notion was that if we do not get the dividend, we are we are still better off, because that man which was supposed to be given to us as dividend is going to be reinvested in the company, and through those investments which yield positive NPV, and by so doing our wealth will increase. So that's capital growth. So in other words, it is irrelevant whether a company pays out all its earnings to shareholders as dividend or retains all earnings from the investment, or any combination of the two. All right, this only happens in a perfect market situation. The reason for this is that although a lower dividend obviously means less immediate cash for the shareholders, this is compensated for by the fact that the extra investment by the company will increase the value of the company and its share value. In theory, the shareholders will be indifferent because the increase in the value of their shares will compensate them for the lower dividend. All right. So you will see that in theory, companies which might adopt this policy or might give this theory a thumbs up, they are those companies which do not, whose shareholders do not actually give a fuss about receiving a dividend, because they know that even if they do not receive the dividend, in terms of their share price, the share price is going to go up because their managers would fight their nails off to ensure their share price grow. Okay, so wealth is being maximized through the growth in capital value of their shareholding. Then we have got what is called the residual theory. This theory is closely related to M&M's, but recognize the costs involved in raising new finance. It argues that dividends themselves are important, but the pattern of them is not. Okay, so the pattern at which the dividends are being paid doesn't matter. For example, are we regularly or constantly paying the dividend? That one doesn't matter. Okay, whether we are constantly paying the same dividend, or we are paying a constant dividend, or sometimes we are paying a growing dividend. That one doesn't matter. Or we are paying these dividends regularly. Again, it doesn't matter. Okay, so what actually matters? That's the big question. The proponents of this theory argue that dividends themselves are important, but the pattern is or does not matter. All right, we'll see in the cost of capital lecture that the market value of a share will equal the present value of the future cash flows. So the residual theory argues that provided the present value of the dividend stream remains the same, the timing of the dividend payments is irrelevant. Okay, as long as the present value of what we are going to get in the future is just the same, whether we pay these dividends today or next year or after 5 years, it doesn't matter. So it follows that only after a firm has invested in all positive NPV projects should a dividend be paid. Otherwise, don't pay us any dividend. Okay, so the dividend should only be considered, or should only be paid after we have exhausted all positive NPV projects. Retentions should be used for project finance, with dividend as a residual process or residual action. So crying for dividends actually is a secondary issue rather. Okay, it is a secondary issue. It is not a priority. We need to prioritize our minds on reinvestment. Okay, on investing in those projects which yield NPV positive first. However, this theory still takes some assumptions that may not be deemed realistic. This includes no taxation and no market imperfections. So, in other words, this theory is actually related to the previous M&M, the dividend irrelevance theory. Okay, because the assumption was that businesses are operating in a perfect market where there are no taxation and market imperfections. So that's a perfect market. But in reality, such markets do not exist, and taxation is actually a reality. So we have got this other theory, the dividend relevance theory. Now, practical influences, including market imperfections, mean that changes in dividend policy, particularly reductions in dividends paid, can have an adverse effect on shareholder wealth. Reductions in dividends can convey bad news. This we have actually seen in reality, where dividends have got what is called a signaling effect. Okay? Then changes in dividend policy, particularly reductions, may conflict with investor liquidity requirements. So there is what is called the liquidity preference theory. Then changes in dividend policy may upset investor tax planning, that is the clientele effect. As a result, companies tend to adopt a stable dividend policy and keep shareholders informed of any changes. So I think there is also need for us to look at these um, dividend policies in practice, okay, where we are saying the dividend actually matters, okay, and there are three sub theories which we need to actually understand: this, the clientele effect, the signaling effect, and the investor preference for liquidity. So let us have a look at the clientele effect. Investors have diverse preferences. Over time, investors naturally migrate to firms with a dividend policy that matches their preference. Some investors, they are cash happy. They want to have their dividends regularly. So if they look at the performance of um, investments, they usually go for those shares which offer dividends regularly. All right, so because that's what they prefer. All right, so if you want to make your investors happy, you need to know what they want. Otherwise, your dividend policy is going to have some negative consequences. The existence of the clientele effect implies that A, firms get the investors they deserve, and B, it will be difficult for a firm to change an established dividend policy. So you discover that even if you are so innovative, sometimes certain policies do not change overnight. Okay, you need to market your idea until it sinks in the mind of the investors. Otherwise, you might mess things up. All right, so you need to this is why certain cultures in terms of dividend policies are there to stay, because it is actually difficult for a firm to change an established dividend policy. A constant dividend policy, for example, always distributing 20% of earnings or always increasing dividend by 5% per annum, will attract a group of shareholders to whom the policy is suited in terms of, for example, their tax position or their need for income. Changing the dividend policy will upset these shareholders. Several scholars have argued that dividends can mitigate agents' costs. A firm that pays regular dividends can reduce managerial propensity to waste resources, because they know that if they just waste resources, by the end of the day, the cost will be high and they might end up failing to pay dividends, which might upset investors. So in other ways, the constant dividend policy is actually reducing or mitigating the agent's costs. Agent costs, these are the costs related to managerial behavior, the behavior of managers. Okay, so they are the agents of the company. So if they are errant, or if they adopt an errant behavior or an errant attitude towards the governance of their companies, then by the end of the day, the companies will be exposed to business risks, financial risks, and so forth. So the agent cost will be high. So if we are having a viable dividend policy, then, like for example, a regular dividend policy, then we are indirectly influencing managers to toe the line, to behave in a conscientious way. All right, now let's look at the signaling effect of a dividend. How can firms that have promising prospects convey information credibly to the market? According to the signaling theory, these firms need to take actions that cannot be easily imitated by firms that do not have such promising projects. One such action is to pay more dividends. This suggests to the market that the firm is confident of its earning prospects that will enable it to maintain higher dividends in future as well. This is a positive signal from the market, and it has a buoying effect on the stock prices. So if we are seeing a company that is regularly paying dividends or that is paying more dividends, this might sound to potential investors that this is a good company and we also have to invest in that particular company. By the same token, a decrease in dividends is perceived as a negative signal by the market because firms are reluctant to cut dividends. Consequently, such an action leads to a drop in stock prices. Okay, so that is the idea. Lastly, we have what is called investor preference for dividends. If taxes and transactions costs are ignored, dividends and capital receipts should be perfect substitutes. Yet there appears to be a strong demand or preference for dividends. Schefrin and Meyer-Startman offer explanations based on behavioral principles of self-control and aversion for regret. In essence, they argue that investors have a preference for dividends due to behavioral reasons. Hence, dividends and capital receipts are not perfectly substitutable. Alright, so usually investors prefer some form of dividends as a way for their liquidity preference. Alright, because normally capital receipts, although they do not attract things like taxation and so forth in the shorter term or short term, there is a general preference for liquidity. Okay, investors, when they put their money in an investment, they expect to get some regular income. All right, so this is something to do with the behavioral attitude or principles of various investors. All right, so usually dividends are actually cannot be at par or at the same level with capital receipts, because dividends are regular income, and you understand the idea of the bird in hand. Okay, the bird in hand is actually better or is worth more than that one in the bush. All right. Okay, now let's look at the dimensions of dividend policy. All right, these ones are actually the practical issues that are considered whenever financial managers are deciding on what dividend shall we pay. All right, so the dividend payout ratio, I'm sure you are conversant with this ratio at this level. Okay, dividend payout ratio. Okay, basically dividend payout ratio is given by total dividends. Remember, these are monies, okay, divided by the net income or profit after tax. Okay, total dividends divided by net income or profit after tax part. All right, or dividend payout ratio is equal to dividend per share over earnings per share. Please be conversant with these formulas. Okay, be conversant with these formulae because they always come in the exam and you mustn't be found wanting. Now, what determines the payout ratio? All right, number one, the fund's requirement. All right, and this is actually in line with the residual theory. Normally, if firms have got substantial investment opportunities and consequently considerable funding needs, they tend to keep their payout ratio rather low, okay, to conserve resources for growth. All right. Then, on the other hand, firms which have rather limited investment avenues usually pursue a more generous payout policy. So, if we need to invest, in more new projects, or to expand, if we want to expand our company, we normally preserve our cash, our coffers. Okay, we conserve the resources because we do not want a situation where we end up having no funds to fund those projects. Then, liquidity. This is an issue related to the liquidity preference theory, where we are saying that dividends entail cash payments. Hence, the liquidity position of the firm has a bearing on its ability to pay dividends. So, if we have the money, we can pay. But if we do not have, we tend to pay a low dividend, or sometimes we might decide to pay dividends in the form of shares. Right. So the liquidity is something to do with the availability of cash to pay the dividends, or the needs of our shareholders for cash. All right. Sometimes they might not want the cash now. Okay, they might be preferring to have their wealth in the form of capital appreciation. So in other words, they might be saying, just reinvest, we do not want the cash now. All right, so liquidity can be explained either way, okay, in terms of the cash availability in the coffers of the company, or in terms of the cash requirements in the hands of the shareholders. That's liquidity. Then, when you are talking of the access to external sources of funding, sometimes we might be having a lot of sources which are ready to give us money. Remember, we discussed about the sources of finance. All right, so sometimes we might be having a lot of those sources. So if they are available, then we can pay a generous dividend. We can have a generous dividend payout ratio. But sometimes when we can see that we've got limited sources, then we are having a situation of hard capital rationing. Then we can restrict our dividend. So the dividend payout ratio would be a bit low. Then the shareholder preference, we talked about this one during the liquidity discussion, but we can as well recap it here, where we are saying that the preference of our equity shareholders is something that we need to consider. Remember the clientele effect. Okay, if we disappoint them, then by the end of the day, we are likely to have their resistance, their annoyance. They might be annoyed, and if they are annoyed, they end up disposing of the shares en masse, and that will crumble our share price. Okay, that's if they are preferring cash, let us give them the cash. It means that our dividend payout ratio would be forced to be high because the shareholders want cash now. Then the difference in the cost of external equity and retained earnings. Sometimes it might be sometimes to the magnitude of cost differential between external equity and retained earnings has a bearing on the relative proportions of external equity and retained earnings used by the firm, and hence on its dividend policy. Okay, sometimes it might be very expensive to have external funders in the form of issue of shares. Okay, when we issue shares to the public, then sometimes the shareholders might be expecting much return, on their investments, and this might force the company to just rely on the retained earnings, all right, which might seem to be cheaper. But to rely on retained earnings simply means that it will have a negative effect on the shareholders who would want those retained earnings to be minimal after they receive their dividends. The shareholders might insist on their dividend, and you will discover that the retained earnings approach or the retained earnings funds funding technique would be not palatable. All right, so it's a win-win situation. It's a you need to consider the impact or the dividend policy at play. Then control. If the shareholders and management of the firm are averse to dilution of control, the firm should rely more on retained earnings. You discover that some shareholders do not want to dilute their control. So in that situation, either you can raise funds through rights issue, as we have discussed, or you can raise funds through retained earnings. You need to fund your project through retained earnings, because by so doing there is no dilution that is going to take place. There is no dilution that is going to take place. Then taxes, the impact of taxes. There is an effective indirect tax on dividends as compared to long-term capital gains, which are tax exempt. Usually capital gains, the long-term capital gains on the share price, the share price increases are not taxed, or they are tax exempt. All right, so given this tax differential treatment, the tax factor per se favors a niggardly payout ratio. Okay, that is what happens. Okay, so this payout ratio is actually frugal, okay, stingy, okay, or ungenerous. Where we are just paying little. All right, so that is that. Now let's move on to this last aspect, where we'll be discussing about the capital structure and financial ratios. But on the financial ratio bit, we are not going to talk much, because that one is, we did those ratio, the ratio thing, we did them in our first lecture when we discussed the introductions. When we discussed the introduction to this subject, financial management. And ratios, it's just a bit of practice, and they are actually self-explanatory. All right, so capital structure is just the choice. Okay, it's just a choice. It's just the mixture of or the ratio of finance within a company. Okay, so by learning capital structure, we are being taught to consider the choice between raising finance from either equity or debt, okay, and discuss the best proportion or the best mixture possible a company should adopt. All right, so that's the idea. However, there are certain issues which we need to discuss, that is financial gearing and operational gearing. Now, when you are talking of financial gearing, this is just the measure of the proportion of a company's financing that comes from debt as opposed to equity. The attraction of debt finance is that lenders are likely to require a lower return than shareholders, because an investment in debt is less risky than an investment in shares. In addition, debt interest payable by the company is normally allowable for tax, which makes the net cost even lower. However, the reason that companies do not automatically raise as much of their finance from debt as possible is that increasing the amount of debt in a company or increasing the gearing creates more risk for the shareholders. Okay, this risk is attached to unbearable interest payments. Okay, so there is those interest payments plus the repayment of the principal. So that risk is might actually get, unmanageable, and this might risk closure of the company. The reason for the increase in risk to shareholders is that fixed interest must be paid each year before the company is able to pay the dividends. All right, so this is the risk, the financial risk attached to debt finance. Now, let's have a look at this example to see or to learn more about financial gearing, because this is part of our baby this week. Two companies, Eugene and Gilbert, are both generating operating profits before interest of $100. Eugene is an ungeared company with no debt finance, whereas Gilbert is a geared company and has to pay debt interest of $30 per annum. Tax is payable at 30%, and both companies distribute all available earnings as dividends. Now, this is Eugene's statement, and this one is Gilbert's statement. These are the profits. And in terms of debt interest, Eugene is 0, as you can see, because it is ungeared. Ungeared, which means it is only financed by equity. Then this one is geared, so it pays interest every year of $30. So you can see in terms of profits, okay, before tax, this one has got 100, this one has got 70. Then the taxation, you can see that the taxation here, this one has no debt, but you can as well see that in terms of taxation, it has got more taxation that has been levied, but this one has got lower taxation. All right, and available to shareholders, the cash, the profit after tax is 70, and this one is 49. Okay, then calculate the percentage change in dividends that will result in both companies if profits were to fall by 20% or by 40%. All right, so we are required to determine the impact now if there is a change in profits. All right, remember, we are having one company that is ungeared and another that is geared. Okay, so our solution, part A, we are having a company, Eugene and Gilbert. These are the two companies which we are considering. Now, the profits are said to fall by 20%. Okay, they are going down 20% under part A. So they were 100. They were initially 100, but if they fall by 20%, it means the profits are now 100 multiplied by 0.8. So we are having 80 in terms of profits. But in terms of debt interest, the interest here, we don't pay any interest, but here we are paying 30 every year. So the profit before tax is 80, here is 50. Then in terms of tax, at 30%, here that's 24, but here that's 30% of 50, that's 15. So obviously here it's 56, That's the profit after tax, and here that's 35. Now, what about when the profits fall by 40%? Okay, if the profits fall by 40%, all right, let us try to squeeze our thing here. Because of my space. All right, this is Eugene. The profits have fallen by 40%. Okay, this time by 40%. All right, so if they fall by 40%, they were initially 100, so multiply by 0.6, because we removed the 40%, we are left with the 60%, so that's they become 60, and there's no interest, so we have got 60 here, and then here we pay 30, so our profit becomes 30. And then it's the tax here for Eugene, that's 30%. 30% multiplied by 60, that's 18. So obviously the profit is 42. Profit after tax, but here 30% of 30%. 30% of 30%, that's 9. The profit becomes 21. Okay, now the percentage change in profits, the percentage change in profit in Eugene, all right, the percentage change is actually when there was a fall of 20%, the percentage change was actually, because initially the profit was 70. Okay, the profit was 70, so a movement from 70 to 56, that is 70 minus 56 over 70, that's 20%. Okay, so a percentage change in a fall in profitability would also be, lead to a fall in the ultimate profitability. Okay, a fall in operating profit would simply lead to a similar fall in the part or the ultimate profitability in the same fashion. Okay, so that there was a 20% fall in operating profit. This was pronounced in the same way with the fall in the profit after tax. However, this was because it was a geared company, but you will see that in an ungeared, this was an ungeared company. Okay, this one is ungeared firm. Okay, then you also see in the when the profits fall by 40%, there was a movement from the original the space there. All right, the original profit, when the original profit was 70. Let us just concentrate on Eugene before we go to Gilbert. From 70 to 42, over 70, you can see that this is 40%. So the point has been proven that a decrease in operating profit would lead to a same decrease in profit after tax if the firm is ungeared, if there is no debt interest. Remember, debt interest is a fixed burden, is a fixed charge, is a fixed cost. Interest is a fixed cost on a firm. So whenever it appears, it will lead to a drastic, okay, or a magnified fall. All right. This is the same principle that is going to be adopted when we are talking of operational gearing, because we'll be saying that the appearance of fixed costs is actually going to multiply the effect, okay, of the reduction or increase in profitability. So in this case, the fixed cost here is the debt. So in an ungeared firm, there is no debt, there are no debt interests. So a 40% fall in profits will ignite a 40% fall in profit after tax. A 40% profit a 40% fall in operating profits or profit before interest and tax is likely to lead to a 40% fall in the ultimate profitability or the profit after tax. Now let us look at the geared firm Gilbert. Gilbert's initial profit was 49, okay. However, when the profits fell by 20%, the profit ended up to be 35. So the difference was 49 minus 35 over 49 initially, and this led to a 29% fall. There was a 29% fall. However, in the second phase here, the profits fell by 40%, okay, to come to 21 from 49. So 49 minus 21 over 49, this actually comes to 57%. So you can see that the fall in profits was initially 20%, but it ignited a fall in profitability in a multiplied sense, okay, 29%. Then a 40% fall led to a 57% fall in ultimate profitability. So that's the impact of the fixed cost, which was interest payment. Now, there are measures for gearing, and these ones we know them. Usually we know them. When we want to measure the gearing of a company, all right, there are certain ratios which are standard, okay. The first one is for financial gearing, the first one is debt borrowing plus preference share capital over ordinary share capital plus reserves, right? So this one actually tells us that we normally say debt over equity, all right. But when you are saying debt over equity, there is debt borrowing plus preference share capital. Preference share capital is usually considered debt finance. So in an exam, you need to consider the debt, the usual debt, that is the debentures or long-term liabilities sometimes, and then the preference share capital is also part of the debt, divided by ordinary share capital plus reserves. And I pointed out initially that when we are talking of ordinary share capital, this includes the nominal value, the nominal share capital plus the share premium, okay, plus reserves. Reserves include those revaluation reserves and the other reserves, okay, including also the retained earnings. Do not forget that, including the retained earnings, they are also part of the ordinary share capital or the reserves. Okay, then we have got debt borrowing plus preference shares over long-term capital. Sometimes we just consider all the long-term capital, which includes um, the equity plus the debt. So that's here in this case we are simply saying D over A plus D, total long-term capital. All right, the long term. So we are not including the current liabilities, but any other capital there is actually going to be considered. Okay, those are the measures. Now let us have a look at this particular example and see if we can make sense out of it. We're given this example. FARI POC is the following summarized statement of financial position. So we have got non-current assets 200,000, current assets this much, and the total assets are those ones. The share capital is 10,000, 10 cents shares. So how many shares are we looking at here? The number of shares is actually going to be 10,000 divided by 10 cents. 10 cents is the same as 0.1, which actually means that we have got 100,000 shares in this particular company. Then reserves, that's 130,000, and debentures this much, current liabilities, and come to 250. So we are told that the market values at date of the statement are the shares are worth $2.20, and then the debentures are quoted at 95 cents. Now, or 95%. All right. So calculate the gearing ratio of FARI using market values and book values and market values. The book values are the figures which are given in the financial statements. The figures which are given in the financial statements. So using book values, the book values, the gearing ratio is equal to debt 100,000 over 100,000 plus 140. Okay, here we have just followed this last formula. Okay, debt borrowing plus preference shares. Okay, here there are no preference shares, don't worry about that. So we can see that this equal to 42%. Now let's use the market values. Using market values, GR is equal to the debt is 200,000, but multiplied by 95 cents, which is 0.95, or over 100,000 multiplied by 0.95 plus the equity as the equity is, now we need to pick the shares. Okay, 10,000 multiplied by $2.20, because the shares are worth $2.20. All right, and we have 30%. Now, when you are using market values, please be careful there. All right, the figures which we have picked. All right, because we don't have the market values for the reserves. All right, usually reserves are company specific. So this is what we have determined. All right, that's how you compute your gearing ratio. Now let's move on to the aspects of operational gearing and see if we can make sense out of this presentation. Now, operational gearing measures the relationship between contribution and profit before interest and tax. So, operational gearing is equal to contribution over profit before interest and tax. It indicates the degree to which an organization's profits are made up of variable as opposed to fixed costs. Now, when you are talking of contribution, ladies and gentlemen, contribution is equal to sales minus variable cost. Don't be confused when you're talking of contribution. Contribution is just sales minus variable cost. What is the significance of operational gearing? The significance of operational gearing is as follows. If contribution is high but PBIT is low, the company has a high proportion of fixed costs which are only just covered by contribution. Business risk as a measure of operational gearing will be high. If contribution is not much bigger than PBIT, the company has a low proportion of fixed costs which are fairly easily covered by contribution. Business risk as measured by operational gearing will be low. Operational gearing, like financial gearing, affects the volatility of earnings. If a company has high operational gearing, a small percentage change in sales revenue will have a much greater percentage change in operating profits. The proportional size of the change is higher than for a company with low operational gearing. A company with with both high operational gearing and high financial gearing is likely to have highly volatile earnings and earnings per share. Now, I think we need to go through this example and see what would be happening. Companies A and B have sales of 100,000 per annum and costs of 60,000 per annum. However, company A has structured its costs such that $50,000 are variable and 10,000 are fixed, whereas B has variable costs of 20,000 and fixed costs of 40,000. So sales, as we have read, 100,000. Now the costs, we are told that the costs are just 60,000. Okay, but the distribution for A is 50,000 variable and 10,000 fixed. Here it's 20,000 variable and 40,000 fixed. So you can see that B has got a larger portion of fixed costs, whereas A is a smaller portion of fixed costs. All right, in terms of their total cost is 60-60. All right, however, the profits are just the same as well. Now we need to calculate the percentage change in profits in both companies that results from an increase in sales volume of 10%, a reduction in sales volume of 20%, and see what happens. So let's start with the increase in sales volume of 10%. So we still have got the same information. So we have got A, we have got B. Now, if the sales increase by 10%, here we are simply saying 100,000 multiplied by 1.1. Okay, that's the increase of 10%. So you multiply by 1.1. If it was an increase of 5%, we're going to multiply by 1.05. If it was an increase of 20%, we're going to multiply by 1.2, and so on. Okay, so in this case, if we multiply 100,000 by 1.1, we're going to get 110,000. So in both companies, we're going to have 110,000. All right, we underline as given in the question, and then let's determine the variable costs. The variable costs will remain let me see, an increase in sales volume by 10%. Okay, usually sales tend to increase with the rate of the variable costs. All right, so the variable costs also have to increase by 10%. So if they increase by 10%, this means that we're going to say 50,000 multiplied by 10%. I mean, multiplied by 1.1, because that's an increase by 10%, and they become 55,000. But the fixed costs, they remain like that. They don't change. So for A, they remain as 10,000. Then for B, if the variable cost increase by 10%, it becomes 20,000 multiplied by 1.1, so we get 22,000. But the fixed costs remain the same. So if we add up, we now have 65,000. Here we now have 62,000. So this taken from 110, we're going to have profit of 45,000. That's the profit. And this figure 62,000 taken from 110,000, we are having 48,000. Okay, now this is what happens in the case of an increase. Okay, an increase in sales volume. All right, the company that has got fixed costs is likely to have a larger increase. All right, if there is an increase in terms of the sales volume, then in terms of profitability, there's also going to be a high increase. However, if there is a fall, we need to witness a big fall in profitability. All right, but what is the in terms of changes? Let us look at the changes. At what rate were the profits increasing? So let's look at this first, the increase in profits. The increase in profits for A, there was a movement from 40,000 to 45,000. So that's 45,000 minus 40,000. Over 40,000, and this shows that there was a 12.5% increase. But for B, there was a movement from 40 to 48,000. So that's 48,000 minus 40 50,000 over 40,000, and this was actually a 20%. So you can see that the actions of fixed costs is not anything to underrate. Okay, fixed costs are actually real. All right, let's look at the second situation where there is a reduction by 20% in terms of sales volume. All right, so in this case we still have got our A and B company. So the sales initially were 100,000, but they've fallen by 20%. So we are now having 80,000, 80,000. And then we have got variable costs. These ones have to also have to fall by 20%. So initially we were having 50,000. So that's for A, that's 50,000 multiplied by 0.8. So we have got 40,000. For B, we initially had 20%, 20,000 multiplied by 0.8, that's 16,000. Then the fixed costs, these ones, they remain as they were, so that's 10,000 and 40,000. All right, we add these costs up, that's 50,000. This one, that's 56,000. We then have to subtract this figure from this figure, that's 30,000, and subtract this figure from this figure, that's 24,000. So the decrease in profits, for A, we moved from 40,000 to 30,000, 40 to 30,000, so there was a decrease of 10,000 over 40,000. This means this should actually be 25%. Okay, remember the profits had fallen by 20%, but the impact was actually 25% in terms of the ultimate profit. The sales had only fallen by 20%, but the impact was 25%. Why? There was a fixed cost here of 10,000. However, if we have a larger fixed cost, the sales had fallen by 20% from 40,000 to 24,000. So 40 to 24, that's 16,000 over 40,000. And this signals a fall of 40%. That's a tremendous fall. Okay, so this is why we made this statement that if the contribution is high but PBT is low, the company is not like that, not that statement. If a company has high operational gearing, a small percentage change in sales revenue will have a much greater percentage change in operating profits. The proportional size of the change is higher than a company with low operational gearing. So you can see that in terms of operational gearing, A has got a lower operational gearing, okay, as compared to B, which actually has got more operational gearing. This is why we are having that significance. But let us verify the operational gearings of these companies to see, just for interest's sake. Okay, we have already pointed out that operational gearing is equal to contribution over PBIT. Okay, so what is the contribution for A? A contribution is equal to 100,000 minus the variable cost 50,000. So which means the contribution is 50,000. And then for B, the contribution for B, that's 100,000 minus the variable cost of 20,000, which is equal to 80,000. Now, their PBT, okay, their PBT, we can just take the 40,000s, these profits, okay, just assume those ones are the PBIT. So the operational gearing for A is equal to the contribution 50,000 divided by the PBIT of 40,000. Okay, so you can see that in this case, the contribution, let me use my calculator. Where is this calculator of mine? That's 50 over 40. Okay, that's 125%. But for B, operational gearing B, this one is 80,000 over 40,000. You can see that this one is 200%. So it has already been seen or proven that B is heavily geared in terms of operational gearing. All right, so this is why you saw that a small percentage change, okay, in part A here, you can see that the percentage change, the same percentage change of 10% only ignited a 25% change in terms of profits. All right, in terms of the increase in profits. But when it comes to B, it was actually tremendous. Okay, it was tremendous. The 10% rise in sales volume ignited a 20% rise in profitability. Similarly, here, I mean, when there was a reduction, a 20% reduction only caused a 25% reduction in profits in A, but it ignited 40% reduction in B. So fixed costs, they actually matter the most. All right. Now, I think we have done everything, and if you feel like you need this type of coaching, please don't hesitate to contact me. I will always be there for you so that we help one another. These are my numbers, and don't forget to subscribe. Okay, please subscribe, okay, like the video if it is helpful, okay, and share it to your friends and peers. So until next time, ladies and gentlemen, please continue to feel very excited. I mean, very, very excited. I am signing out. Thank you very much. Bye.